Blowout tech earnings and strong ISMs, not enough to keep this rally going. The dollar stages a bounce, and oil and gold join the commodity rally. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, guys. Today is the 4th of May, and let's have a look at these markets. So what's been going on? So we had flagged last week that the NASDAQ particularly was likely to struggle to make new highs, even if the earnings were pretty decent, right? And that's exactly what we got. So we got blowout numbers from the likes of Facebook, Amazon, Google, and what happened? The NASDAQ just drifted lower throughout the week by about 1%, right? And it's heavy again this week, right? So that's quite telling that we were seeing, reasonable beats, and the market just couldn't really, even though some of the stocks were higher, finished higher, the overall broader market just couldn't manage it, right? So, and you also had the S&P trading in a pretty tight range, around a 1% range between 41.75 and 42.20 all week. And then even the Russell drifting a bit, feeling quite heavy towards the end of the week as well. Reasoning maybe Q1 GDP numbers came out a little bit below expectations, even though they were still good. But just in general, markets kind of really not managing to make new highs, despite what is looking like a pretty decent earnings season, right? So 90% of the earnings so far have beaten expectations, and normally about 70% beat if you look at like a 5-year average. So, but the market reaction so far is kind of suggesting that was somewhat priced in, right? So the market hasn't been surprised by earnings beats in general, and it seems people were quite well positioned for that. So you didn't see that much incremental buying flow on the back of strong earnings. Yeah. Let's take a look at some of the charts. If we bring up the NASDAQ first. So yeah, like we said, kind of consolidating now throughout last week. I've mapped out a few support levels I think we need to keep an eye on this week. So I've got 13.7, which we're kind of there. This is delayed, so this is this will update once it opens up. But 13.7, which we're pretty much at. 13.5 below that, and then below that we've got kind of a bit lower down, like 13.1. So those are supports I'm keeping my eye on. I wouldn't be surprised if we see 13.5, within the next day or so. It's starting to feel a bit heavy, this market. Now S&P realized vol does continue to fall off a bit of a cliff though, right? So if we bring up the S&P, like I said, it was stuck in a pretty much a 1% range for the whole of last week. And this phenomena that we talk about a lot is the dealer gamma concentration, right? So as dealers have long option positions and markets kind of don't do a lot, you often get a situation where you get close to expiry and that gamma position explodes that the dealers have, and just their hedging activity keeps the market relatively pinned. So it seems like we got a bit of that into month end last week, because that was a reasonable amount of open interest there, creating a bit of a gamma position for the dealers. Yeah, it's quite typical as well heading into summer that you get a drop off in realized vol. Obviously we've got general bullish sentiment and complacency in the market, so lots of vol selling going on, particularly in the index space, and we're in earnings season as well, right? So indices in general kind of don't do a lot, and stocks disperse and move around, so people aren't rushing to buy index vol, right? The next 2 weeks into May expiry, we could see a similar effect if the market kind of stays around that 4,200, maybe up to 4,250 area. I'd expect the dealer gamma to explode again and us kind of get sucked into that 50-point range, right? If you look at the VIX, let me bring up the VIX. See that? So looking at the VIX futures and looking at where the realized is, you've pretty much got the whole VIX curve trading above 20, whereas you've got realized vol closer to 10. So that implied realized gap is pretty healthy still, right? We're looking at 8 vols plus. So, you know, that again, that looks like there's room for, you know, vols to kind of keep drifting in basically, right? Because the realized just isn't ticking up yet, you know? Now, in terms of if, you know, what could make realized tick up? Well, there's this site called SpotGamma.com. And I actually sat down and spoke to the founder of it yesterday. And there's an interview coming out on Real Vision about that this week. And basically, what they do at SpotGamma is they try and track what the street's positioning looks like. And they try and track where the street is long gamma, we say the dealer community, right? So the market makers and the big banks, where they are long gamma and where they run out of gamma and where that flip point is, to try and find trigger points that will identify when the market might start to exhibit more realized volatility, right? And, you know, according to them, and I'll bring up this chart. So they have a model that they run on a daily basis. And, you know, if you're a subscriber to them, they put out charts about and map this kind of gamma positioning across all the major indices. And it just gives you an idea of what is the realistic kind of price movement, because if the street is very long gamma, then the price movement's relatively small because dealers are suppressing that movement. When the market rallies, they've got futures to sell, and when the market sells off, they've got futures to buy, and they kind of keep the market relatively contained, right? If, however, the dealers run out of gamma and go into short gamma territory, which they often do on the downside, then that changes and they actually start to exacerbate the moves. So on down moves, they have to sell more futures and they make the down move bigger. On up moves, they need to buy those futures back and they make the up move bigger, right? So the volatility, the realized volatility tends to be impacted if the dealers are long or short, right? So this chart here, well, this says that the black curve shows you the gamma profile of the street before the month-end expiry. And then the gray curve kind of shows that month-end expiry took the positions down. So they lost about 30% of their gamma exposure, right? And if you look at where that gamma flips negative, well, that gamma flips negative around the kind of 4140 area on the S&P, right? This is the SPDR contract, which is the ETF, but roughly on the S&P, it kind of equates to around 4140. So what they're saying is, if we this week run below 4140, then the dealers kind of don't have any gamma left, and you can start to see a slightly higher realized vol regime where we're getting bigger swings than what we have been seeing. So that realized vol of 10 could likely shoot back to 20 if spot goes below that kind of 4140 area, right? And that's kind of what they're thinking. So it's nice because they're doing it on a quantitative basis, and they're looking at the open interest on all the strikes every day. And as that changes and as that moves around, they're recalibrating their model, right? So it's quite interesting. It's something I've been tracking, you know, for a while. I've been following those guys on Twitter, but now I actually track it in a bit more detail, and I think it's quite useful to kind of be aware of. Yeah. Okay, so that's kind of how the street has been. In terms of the more fundamental stuff, you've had ISM this week come out, pretty positive still, not quite at the high extreme levels that we saw previous month, but still very positive territory. But the rate of change is slowing down a bit, right? And markets, as we see, tend to care more about the rate of change of this data. And if it's starting to roll over from that perspective, you know, even though it's a higher absolute number, markets might not respond too great to that, right? So we're seeing that a little bit. And then the US 10-year has been pretty stable, pretty range bound, right? It hasn't done too much despite continuing high strong data. Non-farms is going to be a key one to watch this week. So we've got non-farms on Friday. And, you know, that's probably what we're watching for the next catalyst to see if we can move 10-year out of its range, right? At the moment, you know, it seems to be locked in this range. It's managed to hold above that 158 support for now, attacking it a bit today. But in general, is kind of, you know, the 150s, mid 150s to 170 has been the range that it's been in for a while. Kind of really needs to break that 175 key level if we're going to get any more excitement out of yields, right, in the near term. So, you know, that seems a bit of a way away, you know, for it to really break, you know, 15 to 20 basis points on a non-farms print. So I don't really think we're going to see that this week, but it might be the trigger, right? It might be the catalyst for some type of move. So, you know, need to watch out for that data point, right? The Fed does keep reiterating that, you know, they care about employment. They're looking at the numbers, and, you know, the unemployment rate of 6% is a little bit flattering given the participation rate. So it's probably more realistically closer to 9%. They're also talking about the bottom quartile of workers in terms of income, and saying unemployment in that part of the kind of population is more like 20%. So they're cognizant that some of the headline data is a bit biased, and they're saying they're willing to let things run hot for those lower income people to kind of get back to work, right? So something to keep an eye on there. If we're starting to see blowout numbers on payrolls, then maybe that brings that is something the Fed pays attention to, and then all that talk around maybe tapering and stuff kicks off again, right, and starts to move bonds. Yeah. Okay. So that's kind of US, what's been going on. I mean, Europe and Asia have also kind of paused. Nothing too dramatic, but they've certainly paused. If we bring up the DAX, you know, it's quite weak today, down 1.5%. I had it actually in a little mini triangle, and it's just broken to the downside on that. So a bit of a downside exit of that triangle. But still, you know, given the moves that we've had over recent sort of months, very much a consolidation for now, you would expect. Obviously, we know that the European recovery is lagging the US. Markets kind of knows that now. So still waiting to see, you know, the European data come through and keep beating to the upside for us to kind of really believe that the COVID hangover is kind of over in Europe, right? And as I was saying last week, you know, maybe looking for European upside calls out to July or something like that, it is a way to play that potentially bullish Europe scenario. And if you think the US leadership is now done, and the next kind of leg higher has to come from improvements in things like Europe, then that might be something to look into, right? Like European calls on the Euro stocks or the DAX, and even some of these US ETFs, right? So if you think the European rally is going to be on the back of, you know, stronger European data because they're kind of coming out of COVID, and arguably the euro is going to rally on that as well, then rather than just buying DAX calls or something like that, you might be better off buying calls on EWG, which is the iShares ETF for Germany. And what happens there is if the DAX rallies and the euro rallies, then that ETF gets a double kicker, basically, because it's denominated in dollars, right? So, and the amount of premium you're going to have to pay for that upside arguably isn't going to be that expensive, and you're going to get the move. If you think the euro's got a breakout to the upside, maybe to 125 on the back of a better European growth story, then you're going to be better off parking your long exposure in EWG than something like the DAX. Yeah, so something to keep an eye on there. And then finally, China. No real love on China still, right? So I had been looking at this KWEB ETF. It had a decent bounce from like the 72.5 area all the way to 79. Getting faded again, right? If you look at the momentum indicator, rolled over, it was on a nice little uptrend line. It's broken back below that line. So no love in China, bounce getting faded pretty quickly. I don't know what to make of it, really. I think for now, it's a wait and see, because it's certainly not confirming to me that the bounce is really on there, right? So I would kind of definitely be in wait and see mode for that. And, you know, other places in Asia are kind of similar story. They're not really going full cylinders. I mean, India's kind of been chopping around, hasn't really got going again. It bounced off the lows, but it hasn't really got going again. All right. Okay, so that's kind of where we are and what's been going on. Coming up this week, you've got more earnings from the likes of Pfizer, Moderna, PayPal, and Square in the US. In Europe, the key German heavyweights, you've got Volkswagen, BMW, and Siemens. So some big heavyweight earnings still to come this week. On the US macro, we already said the ISM numbers have been out, but then non-farms on Friday is going to be the big one that people are going to pay attention to. And then UK Bank of England meeting as well tomorrow. It's going to be looked at. I don't think it's going to be any major market moves there. You might get a little bit of volatility out of the pound, but I'm not expecting any fireworks there, right? If we go into FX and what's been happening in FX, you've got DXY was getting beaten up pretty hard last week, and then staged a pretty dramatic bounce at the end of the week. So I think the weekly chart's probably the best one to keep an eye on, because everything else, it did look like it was breaking down, but the weekly just managed to hang on to support levels, and that uptrend on a weekly chart is kind of still intact, right? Now, like I said, I think a lot of people are ready to jump on the dollar bear. So we'll see how long this bounce can last. I am starting to think that the breakdown in the dollar is imminent. But watch this space. Obviously, the dollar is important for everything from, commodities, gold, everything right now. If yields can creep back to that 175, maybe towards that level post non-farms, then obviously, you'd think the dollar might have some more legs to bounce, right? But let's just kind of wait and see. I think it's a bit no man's land. It's a bit hard to call it right now. Yeah. If you look at the euro chart, it's back to 120. It's got reasonable supports around 119.15 and 117.60 for me. So I think I'd be looking for a pullback into those sort of areas to maybe look to put on some sort of bullish euro short dollar type trades, basically, right? So that's kind of, those are the levels I've got my eye on euro. Okay, so that's FX. Commodities. So what we're seeing in commodities, so I'm going to share this chart that Saxo put out. So this chart here kind of talks about the 1 year implied carry in commodities. And what it's basically doing is it's looking at what the futures curve looks like for all these commodities, right? Because obviously a lot of these commodities, you don't just buy the physical, you buy futures. And different maturity futures trade at different prices. So what it's saying is that there's a backwardation, a big backwardation in a lot of these commodities like corn, lean hogs, sugar, all these things. Bean oil is the one with the highest one. But basically saying what happens is when futures curves go in backwardation, that basically means that there's really tight supply, right? It means that there's a lot of demand for the physical asset, basically. So what that often means, for example, when oil did the opposite, when oil went into a massive contango, it's because there was too much supply, right? And there was nowhere to store it, okay? And it was a really bearish time for oil when it was in massive contango, where the front month futures were really cheap relative to the back months. Well, we've got the opposite in a lot of commodities right now, which is basically saying there's a tightness in the commodity market. There's not enough supply. There's a bit of a supply squeeze going on. And that should bode well for commodities prices in general and commodities returns over the coming months, basically. And we're seeing that, right? We're seeing explosions in copper, in ags, all over the place, right? Natural gas rallying as well, oil's rallying as well. Everything's rallying, right? In terms of industrial commodities, right? So this kind of shows you that market is in a bit of a stressed state. And it's probably likely at least in the next few months to kind of stay in that state, right? So there should be a decent underlying bid to commodities on the back of that. Now, I'd say the risk factors to commodities for me are a strong dollar, which I don't really think is going to happen, right? And China weakness. And given the Chinese equity market can't stage any kind of bounce, that's probably the biggest risk factor. So keep an eye on China. That may well impact, but right now the commodity futures curves are showing you that it's very tight, that market, and so technically it looks strong. Yeah. In terms of what's happened last week, copper and wheat, which were obviously exploding to the upside, have taken a breather. They're kind of chopping around, consolidating, not too far off the highs. Corn still remains strong though. Corn ripped another 4% odd recently, so it keeps charging on, right? So I won't talk too much about copper and grains because we kind of talked a lot about those last week. Gold, on the other hand, Let's have a little look at the gold chart. So what's gold been doing? So obviously it's just been locked in this range, right? Gold, we'd said no man's land for gold. If I bring up this chart here, I was looking at this morning. So gold again, it's kind of found its range now, 1760 to 1800. It's tried to test, it's kind of tested 1800 pretty much 3 times and failed each time. So that's kind of where we are at the moment. You know, real yields have stabilized. They haven't gone too far. So not a lot going on for gold, really. The dollar obviously stabilized after getting sold. You know, so you got the factors that would normally kind of help gold find its direction. They're just kind of flatlining along, not doing too much right now. Now, I do think there's a level in gold between sort of 1800 and 1825, which I think it could manage to stretch up to. So this level here, 1825, I'm watching that. I'm watching for it to kind of show me some weakness in momentum, but kind of just pop its head up towards there as potentially a reshorting opportunity. Because I'm not a massive believer in gold over the summer. I think it's going to have some headwinds, but that's really just based on what I think yields are going to do. But that's where we are, right? It's not really nothing convincing really in gold. Silver, on the other hand, is trying to stage a bit of a breakout. So if you look at there's a resistance level that was kind of keeping a lid on silver, sort of around here, and that's been taken out yesterday. So, you know, let's see if it can have some follow through, but silver kind of threatening to take this level out. Next sort of area, you probably find resistance is going to be around 28 and a half, right? Which from here is, you know, another 5% up, right? So, you know, it's got some potential legs. So, you know, I think silver will be dragged down by gold if gold sells off, but you could have a situation where gold kind of does nothing to grind its way up to 1825 over the next few weeks, and silver catches a bit of a bid, and we find silver close to 28 or around that 28 and a half area as gold is approaching 1825, and then we'll take a look at it and see if there's some shorting opportunities in the precious metals. In terms of oil's finally joined the party. You know, taking out some big big resistance around 65. So yeah, I've been kind of waiting patiently with my oil long that I've had from all the way down here around sort of 57 and a half. So I'm still in that trade. I have been trailing my stop gradually as we've been going up. So I've trailed my stop today up to around 62. So yeah, you know, thinking that we're probably going to have some support even in a pullback around that kind of 63 area. So if we break below 62, I'm happy to take my profit and run. But yeah, oil, I mean, one of the drivers for the oil rally was Goldman's put out a research note predicting $80 this summer. They're seeing a massive demand increase of around 5 million barrels a day coming over the next 6 months. And they just don't think production is going to be able to increase fast enough to compensate that. Now, you could counter that argument and say, well, hasn't OPEC got loads of spare capacity? So, but OPEC don't have a tendency to release that capacity so easily or so quickly, right? So that's the idea. So the idea is at the margin, the changes in the uptick in demand should drive prices higher. Obviously, if prices do squeeze very, very high, then OPEC will probably come back and counter that to some extent. But ultimately, they want to see higher prices, right? So, you know, it is probably a bullish backdrop for oil over coming months. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.